Most people focus on how to buy an investment. But what if I told you the real secret to wealth is knowing how and when to exit? The truth is, your exit strategy is what really sets you up. So today I'm going to break down the exit strategy and why you need one from the very first day. So an exit strategy, broadly speaking, is when you invest your money when exactly you're getting it back. You have to have a plan to get the money back before you invest it. So it might surprise some of you that on each and every deal, I have a plan to get all my money back and all my investor money back before I even purchase the property or the business. Sometimes it works perfectly to plan and sometimes it doesn't. But the point is that I always have a plan before I begin. So I'll just give you an example of 3 deals that we're working on right now. So deal number 1, we purchased in Las Vegas, as many of you guys know, for about $92 million. It appraised a little over $140 million just 2 years ago. So the strategy to get the money back out of that property is simply a cash out refinance or a sale. So we have 2 options, and we grow that very systematically by growing the net operating income. The net operating income is simply income minus expenses. So what we found on purchasing this property is that there were a lot of rents that were not to market in the property. You just pull out the rent roll, take a look at the rents. There was a lot of lift inside of there. In some cases, $200 or $300 per unit. The other thing we found is that there was a lot of room to cut on a lot of the expenses. By bringing it into our company, we're able to put it into big programs for flooring and for insurance and property tax appeals and things like that. So we're able to bring expense savings and also grow income. And by doing that, we're going to grow the net operating income. Now, yes, there's lots of things that have to go correctly in the future, like interest rates and cap rates and loan to values and all of those things in order to get the money out on a cash out refinance. So if that doesn't work, we could also sell the property because we're going to grow the net operating income and it'll be worth more to the next buyer. So those are just 2 options on one property that we recently purchased. This is not something that's going to happen overnight. This is a 2 to 3 year plan to be able to get out your money. But that's okay as long as you understand that it's going to take 2 or 3 years to get there. The second property that we just bought was a 152 unit building that the owner hadn't touched in over 25 years. So you can imagine walking into a unit, it's like walking back in time. 25 years ago was a property that hadn't been touched since the late 90s. So that means it had all-in appliances, original flooring, old paint, old countertop. All of those things, when changed, are worth more to the next tenant. So for this property, it is a clear value add strategy. So we will go into each of these units, upgrade them, and test the market for rent growth. So we already know that we're going to get $150 to $300 per unit, depending on the unit size and depending on what we do inside of those, in rent lift. So this property in 2.5 to 3 years, every single unit in this property is going to have higher rents of a little over $200 more per unit. That, of course, drives higher net operating income, and it also drives more value. These are 2 clear value add strategies that we just recently did this year. So the strategy on that second one is more than likely to sell because the last thing that I want is a property that was built in the late 80s, early 90s that's been renovated. I would rather take all of that money, move it forward through a 1031 tax deferred exchange and buy like a 200 to 250 unit brand new Class A property with all the bells and whistles. So a 1031 exchange is simply just taking a capital gain from a property that we just made and putting it into a 1031 intermediary. So it's essentially like putting all the money that we made into a bank and you can't touch it or it's taxed. If you have to identify another property with a certain time period, you can roll all the money that you just made from a property, all the capital gains and everything, and roll it into something newer, bigger, better, and not pay any tax in the meantime as long as you don't pull the money out. So that's what a 1031 exchange is. Exact same strategy that we're doing with a big institutional group currently right now, where we're selling 5 of our existing properties, but we're taking the majority of the profits and rolling them into other assets through a 1031 exchange. So the 1031 exchange is something that people use all the time as one strategy to be able to keep the velocity of money moving. So the next property that a lot of you guys have already heard about is the one called Mason Ranch. It's a 312 unit ground up construction. So Ross and I bought the land, did all the work to get shovel ready. And we even did a YouTube video on this. This is just dirt today, but we're gonna turn it into a project that's gonna generate millions of dollars in cash flow. So you can click here to see the whole journey on the land itself. But both Ross and I have about $6 million invested into this property so far. So we'll take that, we'll get a new construction loan, and we'll build this incredible, beautiful luxury property in Tucson, Arizona. When we stabilize, which will be several years from now, we'll then go to a bank for a conventional loan. Now, that could also be Fannie Mae or Freddie Mac. Once we build the property, it will be worth significantly more than we're building it for. The bank will come in and put a new loan on the property, and we will pay off the construction loan. This is essentially a cash out refinance. So the process is really simple. Ross and I get the land ready to build. Investors like ourselves invest into the deal alongside of a construction loan, and you start the project. Then when you stabilize through our management company, we bring in a new bank to pay off the construction loan and as much equity as we can, which is essentially a cash out refinance. For that project, because it's brand new and something that we are building, we're probably going to want to keep that property for a long-term hold because it's a 2025, 2026 build. It's incredible, great location. It took years to get the land. So why would we just flip it and sell it to somebody else when it's going to produce a great return for our investors anyway? And if you're an accredited investor and want to see more about that deal, just click here. So each one of those explanations have a very predetermined exit strategy. And so for some of you, you might have a short-term exit strategy and some might have a longer-term exit strategy. I would also encourage you to take a look at your tax strategy and your passive income strategy as you determine what you're going to do with an exit strategy. So a cash-out refinance where you keep the property, you actually do not have a tax issue because new debt is taking out old debt and it's not a sale. So you can scoop that money tax deferred, put it in your pocket and use it for something else. The second strategy that I talked about with Boulder Creek, that is going to be a 1031, also a tax strategy, and we're going to roll that into a newer asset. Whereas Mason Ranch is just going to be a pure cash out refinance strategy from a construction to permanent debt. All three are very different. All three have different outcomes. All of them consider the tax implications and the passive income moving forward for the partnership. Two things you got to consider when you're just doing a pure exit strategy. An example that any of you could do at any time is buy a 1 acre piece of land for $290,000 that has a billboard on it. So many of you heard this story. If you don't have the $290,000, take a look at some of my other videos and you'll find exactly how you could partner with somebody that does. But just because you don't have the money does not mean that it's not a good deal and you shouldn't do it. In this particular case, I bought this land and it had a billboard right in the center. What I really wanted was the billboard and not the land. So what I did was I bought the land with the billboard. I hired a billboard management company, and within 6 months, the billboard was producing anywhere from $3,000 to $5,000 per month. Two sides, so it was like $1,500 to $2,500 per side. The billboard itself was producing about $50,000 a year of passive income. So I bought the land for $290,000, but I wanted the billboard, and then the billboard was producing about $50,000 a year. So what I did is I took the money that I had made from the billboard and I created an easement around the billboard. And the easement simply just gives me access to the billboard itself. And then I relisted the land and sold it to a home builder. I bought the land with a billboard, but sold the land without a billboard. And so I kept the billboard that was producing $50,000 a year. And I sold the land for more than I paid. So I made a little bit of profit on the land and I got the billboard for free, which now I still own and produces about $50,000 a year in passive income. So it's important to understand that before I bought the land, the exit strategy was to sell the land and keep the billboard. That was always the case. And the goal was to get the billboard for free, which is exactly what I did. I did not know at the time how much passive income the billboard would make, but the goal was to get the billboard for free and sell the land for more than I bought it for. And that's exactly what I did. A lot of people spend all their life behind the spreadsheet, and I call it analysis paralysis, and they never do anything. All real deals are what you see. It's interesting to me that somebody could be a broker or salesman and just work for commissions their whole life while people are making all kinds of money on things that they're selling. Every single deal is what you see. We bought a really nice 10-acre piece of land on a major corner. Now, as a multifamily guy, I see 200 units. An office building might see 50,000 square feet. A self-storage might see 4, 5, or 600 units. A home builder might see 20, 30, 40 houses. A custom home builder might see 10 houses. The point is, same piece of land, you see something very different. When you start to get seasoned in real estate, as you start to see deal flow, then what you realize is that how you make money is traditionally what you see that other people do not see. So many people pass on this 1-acre piece of land with a billboard on it, where all I saw was the billboard, and that was the asset that I wanted. So the key takeaway for everyone to understand is that you always have to have an exit strategy before you buy. So if you want to see how you turn a piece of dirt into $87 million, let me show you how we're taking 19 acres and turning it into 312 units. And you can watch that video here.